Hello everyone, I am Poornima. I am going to present on the topic repo rate, reverse repo rate, cash reserve ratio and bank rate. Let us understand what is a repo rate. Repo rate is the rate at which the central bank of a country lends money to commercial banks in the event of any shortfall of funds. Repo rate is used by monetary authorities to control inflation. In simple, repo rate is that rate at which the commercial banks borrows from the central banks on a short-term basis by providing securities. Presently, the repo rate is 4%. Next, reverse repo rate. Reverse repo rate is the rate at which the central bank of a country borrows money from commercial banks within the country. It is a monetary policy instrument which can be used to control the money supply in the country. So basically, the reverse repo rate is exactly opposite of repo rate. Reverse repo rate is an important monetary policy tool in controlling inflation and liquidity. When reverse repo rate is raised, the liquidity in the economy falls because commercial banks deposit more with the RBI. On the contrary, when reverse repo rate falls, liquidity in the economy increases. Currently, the reverse repo rate stands at 3.5%. Let's compare the repo rate and reverse repo rate. Repo rate is the rate at which central banks grants loan to commercial banks against government securities. Reverse repo rate is the interest offered by RBI to banks who deposits funds with them. Repo rate is higher than the reverse repo rate. While repo rate helps to manage short-term deficiency of funds, reverse repo rate aims to reduce the overall supply of money in the economy. Presently, the current repo rate and reverse repo rate is 4% and 3.5%. Next, cash reserve ratio. Under cash reserve ratio, the commercial banks have to hold a certain minimum amount of deposit as reserve with the central bank. The percentage of cash required to be kept in reserve as against the bank's total deposits is called the cash reserve ratio, and banks don't earn any interest on that money. In simple, it is a rate of total deposits which all commercial banks needs to maintain with the central bank of the country. Next, bank rate. A bank rate is the interest rate a nation's central bank charges to its domestic banks to borrow money. Generally, we have two kinds of banks, commercial banks and the central banks of central banks. The Central Bank of India is Reserve Bank of India, and there are various commercial banks. An example of commercial banks is SBI, that is the State Bank of India. So when the commercial banks borrow fund from the central banks charges the rate of interest on the funds borrowed. That rate is nothing from the bank rate. As per the recent monetary policy, the bank rate stands at 4.25%. The difference between repo rate and bank rate. In case of bank rate, there was no securities involved and it was on the long-term basis. In case of repo rate, there is securities involved and it is on the basis of short-term. Similar to the case of bank rate, in case of inflation, the central bank, it increases repo rate, and in case of deflation, the central bank, it reduces the repo rate. Thank you.